Hey everyone, in this video, we're going to do a quick study session where we go over the difference between the long-term rental loan program versus a traditional portfolio loan. So as I mentioned in a couple of videos before, Coventus has a long-term rental loan program, which helps investors buy and hold rental properties with a 30-year loan. And these loans are really good for investors who don't normally qualify for conventional loans. And that could be because they have too high of a debt to income ratio, or maybe they have too many loans with banks. So for example, if you already have 10 plus loans, then it's going to be almost impossible to get another loan from Wells Fargo or Chase. And so in the past, investors would have to go to private money lenders to get loans at 10 or 12%. So our loans, while higher than the bank loans, they are going to be a lot lower than the 10 or 12% that you're going to get from a private money lender. But there is a similar service, which is a portfolio loan. So small banks or credit unions often will allow you to pool all of your properties into one giant portfolio and then give you a reasonable rate on those. And so if we want to understand the difference between a portfolio loan and a long-term rental loan, even as a salesperson, we have to understand our product so we can help and inform our clients why our product is good for their scenario. So we're going to do this together and we're going to understand the differences between our loans versus the bank loans. So if we look at the differences between our loans and the bank loans, I think one of the biggest differences is the amount of documentation that we require. So for our loans, if you are buying in an entity. So if you're buying through an LLC or corporation, then we're for sure going to need the documents. We're going to see the articles of incorporation that states that this is a real entity. And we're also going to see the managing or operating agreement that shows that you as a sponsor are a part of this LLC. You're not just some random third-party person. We also obviously need to see your identification. So whether it be a passport or a license, and of course, these things have to be valid. They can't be expired. We want to see your liquidity statements. So even though we don't necessarily hold on to your money, we do want to see if you have enough funds to pay for the loan. Like the worst thing that a lender can do is give somebody a loan and then see that they go into forbearance the very next month because they don't have enough money in reserves to pay for the loan. So typically we ask for about 6 months worth of the principal, interest, taxes, insurance, and association dues before you close. We just want to see if you have that money in your bank account. And if the property is vacant, we do ask for 3 months of the PITIA in a holdback reserve account. And for the first 3 months, we actually pay for your PITIA through that reserve account. Of course, we also want to see that you have the purchase and sale agreement if you're buying the property. We want to make sure that this is a valid contract, what the purchase price is, who the buyers and sellers are. If the property is being rented out, we do want to see a valid lease and that you are getting your payments from the tenants. So if you're getting payments through cash, then that might not work, but we do want to see if you have the bank statements for every tenant that's on your property. And if you have renovated the property over the past few years, we would like to see a rehab breakdown. And really, this is just for people who want to do like a cash out refi. For people who are trying to do the BRRRR strategy, where they buy a property for really cheap, put in some more money. By doing that, your basis is now higher. And when you do a cash out refi, you can actually get the money that you put into it back. And actually, I made a video about using this product for the BRRRR strategy, which you can find over here. So the banks need a little bit more. So like us, they need the formation documents for the existing entity. Same, they also need the operating statement and identification. But the difference is banks need information about your personal income and your tax returns. So they're gonna wanna see 3 years of your most recent personal tax returns. And they also wanna see a personal financial statement. So that could be a lot of different stuff. They want you to list down every piece of real estate that you own, all of your stock accounts, all of your different business accounts. So that could be a lot of paperwork to just gather. They want the schedule of real estate. So like I mentioned, they want to see every single property that you own. If you own a business, they want to see if you have the 3 years most recent business tax returns. And they also want to see 3 years worth of the most recent balance sheet and profit and loss statements. They also want to see the property management agreement. They want to look at the liquidity statements. So basically, we only care about your gross income. They care more about your entire net operating income and how much you're making per profit. They want to see the entire story behind the properties and they want to see how much you're making as a net profit. They also want to see the purchase and sale agreement and they want to see the HUD for each property. I believe HUD is the insurance documents. So same, they want to see the lease for each property, proof of tenant payment, and property rehab breakdown. So the biggest difference here for documentation are going to be the tax returns. So we don't ask for tax returns. The bank's going to ask for every single tax return that you have, including the ones for your businesses. So another thing that banks require are reporting standards. Their reporting standards are a lot higher than ours, and they're going to require the receipt of a monthly, quarterly, or a semi-annual financial reporting from the borrower and guarantor. All of the covenants are going to be tested during those periodic reporting schedules, and if the target isn't reached, then the loan will be considered in default. What that means is, let's say that you're good for all the requirements of the loan on day one, and you close on the property. But then the bank requires that you do like a monthly reporting of your current financial statement and how things are going. And let's say you have like a rocky month. Normally, when you get a loan and the bank has qualified you, then you have the money and they don't bother you anymore. But with this particular one, for the portfolio loans for the big banks, they're gonna check you every single month or every quarter. And if you don't satisfy the requirements at that time, then they can consider your loan in default. And that means that they can start the foreclosure process on your portfolio. That really sucks because, like I mentioned, imagine you're good on one day and maybe a year or 2 years down the line, something happens. You're good with the payments, but maybe your liquidity isn't as high as you want it to be. Then they can start the foreclosure process on you just because of these terms. And additionally, the banks are going to require that these statements that you send out have to be high quality. So you can't just write some small things in Excel. So for example, they can have in-house quality or compiled or audited quality. And all of these different layers means that you have to have a higher cost to your financial statements, which could cost a small business up to $100,000 per year. So obviously this sucks because you don't want to spend extra money just to get a slightly lower rate on your loan. Here are some of the covenants that the portfolio loans typically require. They need to see all business tax returns, including all the K1s, annually 30 days after filing. They want to see the balance sheet and profit and loss statement 45 days after quarter end. And they want to see an operating statement due quarterly, personal financial statement due quarterly, schedule of real estate, personal tax returns, business and personal liquidities. Wow. So basically they want a lot of different things, and they want to see minimum cash and cash equivalents totaling $100,000 every quarter, and the minimum global debt service coverage ratio of 1.25 times measured quarterly, and the subject standalone debt service coverage of 1.25 measured quarterly. Basically, there's a lot of requirements and a lot of documents that they require in order to keep your loan and make sure that it doesn't get sent to the special assets division. And on top of that, the banks have debt service holdback. So like I mentioned with our product, where we do take 3 months of holdback in case the property is vacant, it seems like banks need 6 to 12 months regardless if it's vacant or not. And they typically hold onto it and they don't give it back to you for another 3 years. So if you're trying to do like a cash out refi, in reality, you may not get as much money as you want back because they're gonna take 6 months of your principal, interest, taxes, insurance, and association dues and just hold on to it for 3 years. So I guess that's the main difference between the bank loans and our long-term rental loans. The bank loans are a little bit cheaper. I think they're maybe in like the 4.75% range, whereas ours are going to be in the maybe 5.25% range, maybe 0.5% difference. But you have to go through all these different requirements, and your money is kind of tied up in a less flexible situation. Also, I haven't even seen what is the minimum for the portfolio size, because for us, our minimum is $75,000 per property, and there's no minimum portfolio size. You can do it a la carte if you want. Okay, so now let's look at the difference between our loan and competitors' loan. So there are other competitors and other hard money lending companies that do something similar to what we do, but of course, these are a little bit different as well. So let's see what they need. For those large portfolio lenders, they're going to need formation documents for the existing entity, but for them, they need something special. They need you to actually create a new entity to put all of those properties into. So if you have those properties in your own name or under an LLC, then they're going to need you to transfer them to this new LLC. And so of course, when you transfer properties from one entity to another entity, you have to pay the transfer taxes on all those properties. And of course, the closing costs associated with moving a property from one place to another place. And of course, that's going to cost a lot of money. They're also going to want to see your personal tax returns and your personal financial statement. Again, we don't ask for that kind of information. They want to see your entire schedule of real estate, your business tax returns, property management agreement, liquidity statements, HUD for each property, lease for each property, and tenant payment. So the biggest difference between them and us is that they need to create a new LLC and move all their properties into it. And they need to see all of your personal tax returns and financial statements. So the most interesting thing about this is that they need to change into something called a Delaware Special Purpose Entity, or an SPE LLC. If the property is already in an LLC, then they have to be transferred into the Delaware LLC, and no exceptions are allowed. And transferring properties can result in transfer tax, which can be expensive. And why a Delaware LLC? It's because that allows for freedom of contract. And the Delaware entities are held accountable to the contracts into which they enter. And other states have less flexible statutes or courts which do not interpret the law as predictable as a Delaware court. So it creates less risk for the lender against claims by any other creditor. I guess as a lender, you want to protect yourself, and by having it under this structure, you know that this Delaware entity wrote the contract and agreed to the terms, and they are accountable for it, so therefore you can just grab the property versus having to go through all these legal loopholes if it's under another LLC. But I guess the big problem is, one, you have to create the LLC, which costs money, and then two, you have to transfer all the properties from the portfolio into this new entity, no matter what. So also, I think a big difference here is how they underwrite properties. So basically, these companies all have a debt service coverage ratio requirement, and whether it be 1.15 or 1.0, your income divided by your PITIA has to be greater than some percentage. For us, we just calculate your gross income divided by your principal, interest, taxes, and association. Whereas for the other companies, they look at your net operating income divided by all those other expenses that you have. So that's why it's actually harder to qualify for those other companies, because whereas for here, they look at gross rents, they subtract vacancy, and they look at credit loss. So your EGI is lower than the one we would calculate because we only calculate the gross rents. And then look at all the different expenses like property management, lease up marketing, maintenance fees, insurance, HOA, property taxes, blah, blah, blah. We only care about insurance, HOA, and property taxes. Let's see. So the net cash flow is $983,000. For them, they have all these extra fees. So the operating expenses are a lot higher, and your net cash flow is $357. So then their debt service coverage ratio is 1.17. I think they have a 1.25 ratio, whereas we only have a 1.15 ratio. So the interest rate is a little bit lower, but we're going to be able to actually do the loan for you. So for the same property, they can't do the loan, but we can do the loan. And let's see, 70% LTV. Yeah, so I guess this is a larger complex. And if you look at the difference in interest rate, it is 0.5% difference, but the actual number is like $800 a month. So you're making a lot more money per month, but your monthly mortgage payment is only $800 more. So let's see, capital expenditures. Money spent to maintain or improve real estate property. Large competitors require CapEx per property from $400 to $800. So average is going to be $600, and they require CapEx to be impounded along with principal, interest, taxes, insurance, and HOA fees. So a 25 unit portfolio, multiply that by 600. I guess it's going to be around $1,500. That means that $1,250 will be included in a borrower's monthly payment. And I guess that's a huge con too, because that reduces your cash flow by a lot. And then when they want to improve the property, it's kind of like a draw. So they have to submit the request along with the budget to get the money back from the reserve account. So even though you're paying like $15,000 a year, you don't get access to that money until you request it and ask for them to give it to you. So that's obviously really bad as well. Whereas for us, we only have the impound for the principal, interest, taxes, and insurance and HOA fees. So this sucks. Honestly, like when I do my own properties and my own flips, I tend to just not get construction loans because they cost more money and it's a pain to like spend the money first and ask for a draw. So that's very similar here, where every month you are paying extra money into this pool that you don't get access to unless you request it from the bank. Okay, so they also have a debt service holdback, and they require debt service for 3 to 6 months. And for portfolios of 20 properties or less, 6-month holdback is required. If you have 21 or more, 3-month holdback is required. So for the loan in the example a couple slides ago, they would have a debt service holdback of $90,000, and you don't even get that back for 3 years. So again, if you're doing a cash out refi and you want the money today, you're actually not going to get it until 3 years later. Okay, so here are some of the loan related expenses. For us, we have a processing fee, valuation fee, so that's how much you pay for appraisals, and legal attorney. So for them, I guess their legal fees are a little bit higher than ours, and that's the main benefit. Okay, so that was the difference between our long-term rental loan program versus the portfolio loans. So it seems like the portfolio loans could have a slightly better interest rate on average, but they require a lot more in terms of the documentation that's required. They require a holdback period, which means that you don't get your funds for 36 months, or you have to put more money down to close on the properties. Some of them require CapEx expenses as well, so that reduces your cash flow. And the way that they look at your properties is a lot more conservative, so they might not even give you the loan. With the same property we saw on one of the slides, one of them didn't meet their debt service coverage ratio requirement, whereas ours did. And that's because they looked at it from a net operating income perspective, whereas we look at it from a gross operating income perspective. So our ratios are easier to hit than theirs. So if you guys have any more questions about the long-term rental loan program, feel free to drop a comment down in the comment section below and let me know your thoughts about the differences between the portfolio loans and long-term rental loan program. I definitely learned a lot from this video, so thanks a lot for sticking with me and learning with me. If you guys did enjoy this video, be sure to smash the like button, subscribe to the channel, and hit the bell notification to see more videos just like this one. Thanks so much for watching, and I'll see you next time. Take care.